In this video, we're going to talk about treasury stock. So when a firm issues stock, so we've got some firm here and they issue stock, and that stock is out on the open market. People like you and me buy and sell it, but the firm can go and repurchase this stock from us, right? You might hear in the news, oh, Microsoft's doing a big share repurchase. There's a variety of reasons they might do that, which we talk about in another video, but suffice it to say they can go and repurchase their stock from people like you and me. So when they repurchase this stock, we have to make some journal entries. So let's walk through what those entries are. So let's have a little example here. So let's say that the firm reacquires 1,000 shares for $50 a share. And we have to say, okay, well, how do we record this in the financial statements? What's going to be the effect on the balance sheet and so forth? Okay, so 1,000 shares, $50 a share. You multiply that, you see that the firm's getting $50,000, or giving out $50,000 cash. So we'll have a credit to cash of $50,000. Now we need a debit to make this balance, right? We need something right here. Well, what do we debit? We debit treasury stock. And treasury stock affects the stockholders' equity section of the balance sheet. And if you remember, our accounting equation, we've got assets equals liability plus equity, right? Now with the cash, we've got cash going down, right? So that's an asset going down. Well, something is going to have to go down on this side, and I told you it affects equity. So treasury stock actually reduces equity. So it's a part of stockholders' equity, but it's something called a contra equity account, in that it exists to reduce equity. Okay, so if you see treasury stock in the stockholders' equity section, it's actually reducing equity. Similar to contra assets that you think about in the assets section, something like accumulated depreciation, you see it in the assets section, but it's not an asset. It's actually a reduction in an asset. And the same goes with treasury stock. It's actually reducing the capital stock of the firm. Now, when we have this journal entry, now let's bear in mind a couple of things. It doesn't matter what the firm originally issued these shares of stock at, right? We're not trying to say, okay, well, when they originally issued it, they issued it for $75 a share, and now they're getting it back for $50, or we don't care. There's no gain or loss. No gain or loss, because a firm cannot recognize a gain or loss ever. This is never a gain or loss when it's dealing in its own stock. And another thing to bear in mind is that this treasury stock, when the firm repurchases this stock, it's not like the stock just goes away, right? So the firm has a certain amount of shares, right, that it's issued, right? But it doesn't automatically retire those shares, right? So let's say, what do we have here? It's 1,000 shares. Okay, so those 1,000 shares are not just, they don't just disappear. Even though they're not for sale on the market, the firm can take those shares and, for example, give them to employees who are exercising their options. So retiring the treasury stock, choosing to say, okay, we're just going to get rid of it, that's a decision the firm can make, but it's not automatic. So when the firm buys back its own shares, they don't necessarily disappear. The firm can give those out. The firm can do a number of things. It can even sell the treasury stock again, but bear in mind, whatever it does, it's not going to recognize a gain or a loss.